Hello, everyone, and welcome to today's webinar. So inside the Mid-Atlantic Fund strategies for returns in real estate. But my name is Andrew Montoya. Like I said, I'm excited to kick off this event about how private lending can be a reliable path to secure and consistent returns. So at the Mid-Atlantic Fund, I serve as the Director of Strategic Partnerships, and my role is primarily focused on connecting investors and partners with unique opportunities that deliver value and stability. So very thrilled to be with you all today. And before we kind of dive in, I just wanted to extend a big thank you to IRA Club for hosting the event, to Ramez and his team for just streamlining everything, putting everything together. The experience has been flawless so far. And thank you for providing a platform to explore these strategies. Were you going to say something? Sorry, I didn't know
No,
if you
I was
were
gonna say thank you for
jumping
the
in.
thank you for the kind words. I did not pay you to say that, so thank you.
No, no worries. But yeah, an introduction to today's webinar. So, we're here today really because the financial world has changed significantly over the past decade. And, leaving many investors searching for ways, to protect their growth and their wealth amid the market volatility. And so this webinar is really going to provide a clear overview of how private lending can fill gaps left by traditional financial institutions, but also offer a way to diversify your portfolio, lock in consistent returns, preserve capital in today's market. But by the end of the session, we're hopeful that you'll have actionable insights to take your investment strategy to the next level. Just an overview of some of the topics that we're going to cover today. So note lending basics, what it means to lend in today's financial landscape, risk management, so how the Mid-Atlantic Fund protects your investments through a disciplined approach, advantages of lending through a debt fund as your asset manager, so why private lending offers flexibility and stability, as well as higher returns, and then simplifying business for investors. So how we make lending a hands-off passive income approach. Really, that's kind of our vision and business models to get investors back to what they're doing and just let the passive income come in. So true hands-off investing, but each section is designed to really give you just a comprehensive understanding of private lending and why it's a powerful tool for modern investors. But an overview of the Mid-Atlantic Fund. So just an introduction into who we are. So the Mid-Atlantic Secured Income Fund is a private debt fund. We specialize in real estate secured loans. We raise capital from individual investors, financial institutions, and corporate entities to fund short-term, first position mortgage loans for construction, renovation, and redevelopment projects. We're based in Atlanta, Georgia, but since 2010, we financed over 500 properties and really have developed a reputation for consistent collateral-backed returns. Our team boasts over 60 years of combined experience. And like I said, we prioritize conservative underwriting, disciplined risk management to safeguard our investors' capital while driving local business and housing growth in the Mid-Atlantic region. And then our team. So before we dive deeper, just a quick intro into our team. Nathan Larson, who's on the call today, our Chief Investment Officer, really brings unmatched expertise in lending and risk management. Josh Bennett is our Director of Finance. He kind of leads the financial strategies with precision. Michelle Abernathy, she's our Director of Operations, so just flawless execution across all of our projects. And then myself serving as the Director of Strategic Partnerships. So our team really works tirelessly to secure returns and profitable opportunities for our investors. But with that, I'll hand it over to Nathan. He'll kind of take you through our approach to risk management, lending strategies, and how we ensure stability and success for our investors. But Nathan, the floor is yours.
Thanks, Andrew. Appreciate that. We begin with a quote from one of my favorite authors, Neil Ferguson. And if you're familiar with some of his work, you'll probably appreciate this quote. But I encourage you to read some of his stuff or to investigate what he's written in different videos and things that he's done. So a few things just to kind of get started with. First thing to understand about what we do, you've probably heard a lot about in the news, like you mentioned earlier, private capital, right? You'll see a lot, whether it's watching CNBC or reading the Wall Street Journal, about how accessing private capital and private capital funds are sort of all the rage. It's growing at 40-50% year over year. And that's what we are doing. We're in the private capital world. We're structured as a debt fund. But what private capital really is it is a more efficient way to be a bank, is in its simplest form. We raise capital in different ways than banks. We offer a few different products as banks, but a bank as we know it raises capital at one rate, they deploy that capital at a higher rate, and they make money on the margin, and they set aside a portion of that to cover losses and risk. The difference is that a bank has huge marble buildings in every town and teams of offices and teams of people and branches and overhead everywhere. And so they make a whole lot of money, and 90% of that money is chewed up in their operating costs and their overhead and infrastructure. Private capital brings a lot of efficiency to that. So we charge a little bit more for our money. We pay a little bit more for our money. We make a smaller margin between the two, but offer a much, much better and much more efficient service, which allows us to pass on 80 to 90% of what we earn onto our borrowers, instead of a banking scenario that would typically pass on 25 to 26%, something like that, onto shareholders and bondholders. So it's a much more efficient way of banking. One of the questions we get probably more than anything is, why wouldn't someone just go to a bank? If we're doing this at a very low risk to low risk projects and low risk borrowers, why wouldn't they just go to a bank? The simple answer is two main functions. One is that we can operate a lot faster than a bank. We can do our due diligence, our underwriting, and get ready to loan on a project within a matter of days. And banks sometimes will take, at best, 90 days, sometimes as much as 3, 4, 5 months. And a lot of times they'll lead you down a path and you don't know the answer until the very end. And you may spend 4 months working on something that you're trying to borrow money on, and you get all the way to the finish line after you've put down tens of thousands of dollars of earnest money, and the bank decides they don't have a product for you. So many people have that invest in real estate and build real estate, develop projects, have been burnt this way. And so having a premium a little bit to the pricing of your debt in order to work with somebody that you know and trust and can deliver a product on a timely fashion means a lot to people. And the second real gap that we fill is in the banking world. They need to develop a product, run it past the board, run it past the government agencies. They need to model it. They need to implement it into their Basel III regulations and do stress testing on it. And it's not worth to them doing all of that time and investing all that money into a product unless you're going to do billions of dollars worth of lending. And quite frankly, a lot of the specialty lending that we do in private capital, we're not going to lend billions of dollars on one specific product. So there's this niche that happened after the Dodd-Frank regulations, after the Great Recession, that were put in place that limited banks in their ability to make those sort of boots on the ground decisions at the local level. And it became much more of a templatized type business. So we're going to talk a little bit about the advantages from an investor standpoint of lending through a debt fund versus doing it on your own. One of the reasons that you would want to do this with an asset manager like us, or with through a debt fund or private capital, is that doing it on your own can be extremely cumbersome, and doing it through in a financial institution can be very risky. Good example is talking about some of the differences here. In our pricing, we will base our pricing, what we charge our borrowers, based on the risk of the scenario. So you've heard in investing a risk return scenario, right? So when we're managing our portfolio risk versus our portfolio yield, we want that to match up very tightly. And we gauge that risk and price it appropriately. With banks, they're going to be based in pricing on what the treasury yields are, what the 10-year treasury bond is, what the overnight banking rate might be at the time, or what their cost of funds are that they have to pay in their money market accounts and various different things. But generally speaking, it's pretty baseline pricing that's based on a product, not on a scenario or a person or the risk of a project. So the other difference is we're going to have a much lower loan to value. If you look at a bank's portfolio in the housing world, it's going to be in commercial world, somewhere around 80, 85% blended. In the real estate world, in terms of residential real estate, it may be as high as 95%. Think about the VA loans, the FHA loans, the 100% loans that they're doing that have, believe it or not, come back now. Our average loan to value in the portfolio right now is around 64%. What that means is if we have $1 million property, we're only going to lend $640,000 on that as a portfolio average. So what that means is that if we have defaults in the portfolio, and the very few that we've had have actually been a windfall for the company. So we don't lose money if someone stops paying us. We actually make more money because we take possession of the property and are able to liquidate it and keep all the profits, believe it or not. So our rates are going to be typically higher because we provide a much better service, and that comes at a price. But we manage that risk by having very short-term loans. The reason that's managing risk is that it's easier to see out into the future a short amount of time. It's hard when you're looking at underwriting a 15 or a 30-year loan to know what's going to happen in a household, in a community, in the country. But it's pretty easy to see out 9 or 12 months, and that's a typical loan term for us. So we manage that risk because the visibility into the future is much easier to gauge at a short term. We've done this now 500 plus times. We haven't had any investor losses in the portfolio. That doesn't mean that we've never experienced a loss, but we have such robust cushions between our reserves and our loss provisions versus our investor obligations. We've built up such a cushion over the 14 years that none of that has ever and will very unlikely ever impact the yields that our investors are accustomed to. One of the biggest things about that is our due diligence process. We are about 92 to 95% repeat borrowers. So many of the developers, contractors, builders that we've worked with, we've done business with them for a decade or more. Some folks we've done 60, 70 loans to. And when you build houses and you work with a bank, you develop a relationship, and that relationship is very symbiotic. They rely on our money to build their business, and we rely on their relationship to build ours. And that type of lending at a community level is a much better way of going about it. We already talked about equity and collateral. So when we're gauging and managing our risk, we look at the 3 C's of lending, and really what those are is credit, right? That's somebody's likelihood based on the past of them paying you back and how you're going to be treated as a lender. Collateral, which is what backs the loan, what kind of asset is backing the loan, and how do you monetize that? How easy it is to monetize if the loan defaults? Character is just what you think it is. It's the character for you doing business with. So we are very picky about who we do business with and have a lot of tight parameters around who we choose to lend to. And capacity is the individual's ability to pay us money when it's due, whether it's to pay us back at the exit plan of a project, or whether it's to pay us our interest monthly, if it's that type of note. So we look at all those four aspects of it every time we determine to make a new loan. So what is our main value to investors, right? If you're sitting watching this, what is it you can expect? So our goal for our investment product for individual investors, institutions, IRA members, we want to create a stable cash flow of predictable returns year over year, do it in a tax efficient way and the simplest model possible. It can be very difficult to lend in real estate because the entry price, if you want to do it as in a first person scenario, those barriers to entry can be very high in terms of initial investments. And it can be extremely high if you're looking to diversify, have a diversified real estate portfolio without doing it through a fund or an asset manager. Good example is here in Atlanta, where we do a good bit of business. If you want to develop one project, maybe you want to build a house, just the dirt alone could cost $400,000 or $500,000. And then if you want to build on that, it may cost another $400,000 or $500,000. Now, if you want to do that and have a diversified portfolio, well, you could be in the several millions before you even get a chance to have multiple projects to protect you. And what you want to do is you want to, especially in a retirement program, you want to eliminate what's called single property risk. So if any of you have been landlords before and you own one property and that property goes vacant for a year or 5 months or whatever, that's 100% of your revenue, 100% of your income's gone. And so there's a rule of thumb that you should never own a rental property unless you own one or own 10. Well, guess what? Owning 10 rental properties is essentially a part-time job, and some would argue is a full-time job, right? So you've got these single property risk scenarios unless you're willing to contribute a lot of time and effort and money into a diversified real estate portfolio. And what we do is we will take different investment sizes from many, many different folks, and we'll put those together and we'll diversify them in 60, 70, 80, 100 different real estate projects at once, so that each investor doesn't have any single property, single investment, single zip code, or single borrower risk. It's diversified over multiple types of properties, multiple sizes of loans, multiple geographic areas. And it's that diversification that protects us and our investors in the long run. Some aspects that are unique to IRA investors, like the UBIT, for example. You can have, Ramirez can jump in here, but you can have, depending on what you're investing in, you can have unintended income in a portfolio. If your investment is to buy and sell cat litter, and all of a sudden you're renting real estate or taking income in from real estate, that's not the intended use of that business.
Nathan, I'm going to chime in on this. So many IRA Club clients that invest in, say, one-off syndications or multifamily deals, you guys always forget to ask the UBIT question or UDFI question, unrelated debt financed income. Okay. One of the things that made this really attractive with Mid-Atlantic was you avoid the UBIT tax. And many of you call the IRA Club screaming off the top of your lungs, how come you guys didn't tell me about the UBIT tax? Well, that's not our responsibility. It is the syndicator or the operator's job to explain this tax to you, right? And that's when leverage is incorporated that you trigger this. This is what also makes this so appealing to an IRA account. And this is what Nathan's trying to drive home for you. It's very rare to find this, okay? And to avoid this UBIT tax. So Nathan, thank you for bringing that up. Because that was one of the things I forgot to tell you about. And you're talking about it right now. So again, if you're planning on investing in this specific fund, okay, not that I'm telling you you should or you shouldn't, because I could never choose the investment for the investor. That's the one thing, obviously, all of you know I can't do, is you avoid this pretty hefty tax depending on the amount that you're about to invest.
Right. And so a good example of that, and you may have many of them, but a good example of that is, let's say, for example, you want to do private lending directly out of your IRA, and you find this guy, Bob, and he wants to borrow money from you, and he seems like a nice person, and he's got this great idea, and you lend him $100,000, and his business fails, or he doesn't pay you back on the rental property he wanted to buy and manage or renovate. And all of a sudden, your way of managing your own risk is to take possession of that collateral, right? And you developed a lending parameter, or you might have a checkbook LLC account that you have, and that business is to lend money, right? And collect interest. And that's the intended use of the business and the investment. But now all of a sudden, you're the owner, your IRA is the owner of property. And your IRA now has to pay property tax and find out how to pay insurance and maintenance on the property. And then if you sell it, you're going to have a capital gain. So now all of a sudden your IRA is operating a real estate business as an owner instead of being a lender and collecting interest. But what we do as an intermediary is all of the distributions, regardless of what comes into our company, all the distributions out to our investors are in the form of interest. So you're never going to have these unintended amounts or types of income or different categorizations of them that could catch you off guard from a tax standpoint. Some of the services we provide on our side that the investor would really not have to do that with, that they would otherwise have to do if they were trying to be a direct lender. But we do all the borrower assessment, qualifying, managing the risk, doing the background checks. We evaluate the collateral. We go through all the contracts. We have attorneys that have written up contracts in every jurisdiction that we operate in. So every one of our loans is closed with counsel at a law firm. We don't do any online closings. We don't do e-signatures. It's not somebody sitting at my desk signing paperwork. Everything goes through our attorneys. We do all the loan setup, the loan tracking, the loan billing. We do all the tax information at the end of the year for how much interest they paid. We help them track the project. We act as consultants along the way. So we'll help them find the best cost in flooring, the best type of roofer to find, who will give them the best payment terms. So we work with them all along with that. We quote payoffs, and then we release the legal liens at the end. So there is dozens and dozens of things that you as an individual investor would have to handle on your own, including legal documents if you want to effectively lend in whatever state you want to do business in. So one of the reasons people often ask us, how are we able to return similar returns year after year, month after month? How do we keep them so consistent? The answer is that we manage our pricing and our risk around a resulting yield. Think about it from the standpoint of begin with the end in mind, right? So we have a portfolio of so many different loans paying different rates into us and maturing at different times, collecting different fees. We have an entire waterfall chart of loans, payments received, what those exit strategies are, how long we expect them to take, what fees we're collecting at the end. And because we have that diversified pool, we have a very modelable income stream that comes into the business. It's very easy to look forward and view into the future 12 to 18 months. Because of that consistent stream of income and the constant liquidation within the portfolio versus some larger funds that invest in larger projects that are development type funds. If you're developing a 500 family, apartment complex, it could take you 6 or 7 years to have actual returns come back in and know what your returns are going to be. Well, in the meantime, we've been paying 8 to 10% out annually, on a monthly basis, to all of our investors, and they get an opportunity to have that cash flow come in and reinvest that cash flow every month back in whatever investments they choose to. We always talk about passive income and the importance of it. And when I say passive income, it truly is passive. Some of our investors choose to have monthly or quarterly calls with me and pick my brain about things, or want to sign up for, our monthly investment council sessions. But that's completely optional, and a lot of people just put money in, some of it from their IRA and some of it just from their investable cash that they had in maybe their brokerage account. And it's really what we call mailbox money. If you do a 3-year commitment with us, for example, Michelle, our director of operations, she'll go into the account, she'll set up a reoccurring payment and set it up for reoccurring for 36 months, and she presses go on it, and it's on autopilot. You get paid on the 5th of every month or twice a year if you choose one of those options. And it's completely hands off. You get visibility into the portfolio and what we're doing, and you can pick our brains from time to time. But it's truly a way to earn stock market plus returns extremely consistently. So yeah, a couple interesting items that our amazing director of strategic opportunities has put in here and built for us. So number one, we have a 90-second explainer video. If you'd like to scan that QR code, it tells you just a little bit more about what we do. Probably most of it you've heard on this call, but it's not necessarily just designed for IRA members. So there's some broader information in there. Check out our website. It truly is designed to tell a story. So if you start on our homepage and read through and walk your way through our story and our products and so on and so forth, it really tells the story of the business. So I encourage you, if you want more information, that's probably the best resource. And then if you want to get started with us, you can scan that number 3 QR code or reach out to Andrew or myself.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.